This quiet suburban Main Street is about an hour from Manhattan, home of the New York Stock Exchange and some of the biggest names in banking. But don't let looks fool you. A lot of the trading these days happens in places like this. On the second floor of this building is a high-frequency trading firm, one of the few that will talk to the press. For a company dealing in the fast-paced world of high-speed trading, where millions of shares change hands in seconds, the offices of TradeWorks in Red Bank, New Jersey, are surprisingly laid back, a place where a handful of young programmers work on complex trading strategies. Firms like TradeWorks have been villainized for contributing to the recent wild volatility on Wall Street.
This is an actual trade that we participate in, which is a moneymaker for us.
But founder Minhaj Narang says nothing could be further from the truth.
And the thing about high-frequency traders in particular is that their buying interest in any fixed time period generally is exactly identical to their selling interest.
Meaning, so you're doing both?
Meaning we buy as many shares as we sell in relatively short time periods. So it's fairly easy to, just as a thought experiment, see that high-frequency traders cannot impact the prices of stocks.
Some of the people saying this, though, are sort of long-time Wall Street people
Sure.
who presumably know a thing or two about this. Why do you think that the attention keeps coming back to high-frequency trading, if what you say is true?
What you see in the financial industry is that lots and lots of firms, the asset management industry in particular, multi-trillion-dollar industry, is under pressure because managers habitually underperform their benchmarks.
So a bit of sour grapes.
It's sour grapes because, look, it's the oldest trick on Wall Street to look for a scapegoat when you can't explain your own performance, right? It's always the case that everyone who's wrong thinks that they're right, but the market is wrong.
I understand that when you say that, and yet when you see 600-point moves so quickly, so viciously, that don't seem to connect to fundamentals people are talking about, it feels like something's spinning out of control. Is that just our lack of comfort with technology? Is it just adjusting to the new reality? Same thing with the flash crash. It seems that something broke or something's not working right.
So I think it's best to answer that as two separate questions because the flash crash really was a peculiar case. Technology definitely played a role in the flash crash, but technology should not connote or imply high-frequency trading. They're two completely separate things. The vast majority of trades that are executed today by all kinds of players, whether they're algorithmic traders or not, are executed by computer. That's a panel that shows the state of our infrastructure. What's happening in the financial industry is happening all over the economy. Technology is wreaking havoc with traditional business models. The way that happens is technology comes in and plays a role in reducing the cost and increasing the efficiency of services that are delivered to the public. Now, that's not always a great thing for the providers of those services because it has a disruptive impact on their businesses, and that leads to lots of finger pointing and lots of defensive behavior, and that's kind of what we're seeing right now as computers play a bigger and bigger role on Wall Street.